So you can see at the top here, I've just got cycle of price action, kind of is how I view this, is it's an objective overlay on my charts via the 10 and 20 period moving average to keep me on the correct side of the market. So in what I call a green light environment, price is above the moving average, or maybe it's coiling below the moving averages and getting ready to break above. I really only take long trades. And then in a red light environment, where we're below the moving averages or possibly getting ready to drop below the moving averages, I'll mostly be in cash, but you could take some short trades too. But it's basically just assigned to me, hey, this environment is not beneficial to making money, kind of go into protection mode. So that's key for me. And overall, this cycle of price action, when I get more into it, there's different stages to it. But it's a great way to allow you to kind of adjust your market exposure and how aggressive you want to be based on where we are at in the cycle. All righty, so I'm going to kind of start at the bottom of the cycle. So basically, when you have a market kind of, it's been in a downtrend, it's selling off, and at some point in time, not always, so not all of these steps always occur perfectly in unison. Sometimes you may get them. Well, let me just explain the reversal extension, work through it, and then I'll kind of talk through some other things. But basically, the reversal extension is once we've kind of been in a downtrend, we may start to get extended, a little overheated to the downside from the 10 period exponential moving average. Oftentimes, you'll see heavy volume capitulation, and it's generally a sign that a market may be potentially bottoming. You don't necessarily know that till after the fact, but that kind of fear in the tape is the first sign of a bottom, and you'll often snap back, usually to the 20 period moving average, and then you'll start to see volatility contract, and you'll kind of have step two of the cycle for me, which is what I call the wedge pop. So for me personally, this is kind of the step where I really like to get involved in the market. I find even if you kind of catch the low via the extension, there's so much volatility in this, period here that you can often get knocked out. So the key is you kind of come up to the moving averages and you base out, you see volatility contract. And then when you pop back up through them, for me, that's the real first beneficial time to get involved in the market. So I call that the wedge pop. And then when you get that first pullback to the moving averages, I call that the Ema Crossback. This is another low risk area to try to execute and get long against the moving averages and try to hop on a potential trend. And then from there, you have what I call basin breaks. So these are essentially, pullbacks to the moving averages. They're usually more than like a 1, 2, 3 day pullback, like a 1 to 2, 3 week base or something like that. And you could, in theory, have as many of them as the stock will continue to put in. But oftentimes, you'll get 1 or 2, and then you're kind of getting a little bit late in the intermediate term trend. And you'll have what I call an exhaustion extension, which is essentially the opposite of a reversal extension. But rather than fear kind of taking over the tape, you start to see euphoria. You'll start to see people start to chase the market up. People start to get really excited about how much money they're making, etc. And when you get extended to the upside, that's often a time to sell into strength. You don't always know that this is going to be the top. The confirmation of that is the ensuing wedge drop. So let me step back over here to the left side. So you've got your exhaustion extension. You'll pull back to the moving average. Then you'll generally kind of base, maybe the market will try to work back up, but it just doesn't quite have the power. And then when it drops back down through the moving averages, that is a sign that, hey, we're in that red light environment now. I want to be more conservative. I want to protect my capital. And oftentimes you'll go through these exact same steps to the downside, but they'll happen much more quickly than on the upside. What might take, 6, 8, 12 weeks, and I'm talking on the daily time frame, to the upside, that could be like 2 to 4 weeks on the downside. So, you get the wedge drop, the Ema Crossback, you might get a basin break, usually only one, and then you'll get like a reversal extension. So that really is the whole price cycle. So a couple things here is that this works on all time frames. So I literally, whether I'm trading on the 5-minute, the 15-minute, the hourly, daily, weekly, monthly, whatever it is, I am using the exact same strategy. So that's important to highlight, just because I find that it allows you to be lethal, and that you're never kind of having guesswork in what you're doing.